Basics of Stock Market Chapter 3. Topic: Why and how do companies list, and what is an IPO? The journey from startup to IPO, unveiling the company life cycle. Companies list on stock exchanges and go through an initial public offering, IPO, for various reasons. Here's a comprehensive explanation. Why companies list. 1. Access to capital. One of the primary reasons companies go public is to raise capital. By selling shares to the public, they can secure funds for expansion, research, development, debt repayment, or other strategic initiatives. 2. Liquidity for founders and investors. Going public allows early investors and founders to sell their shares, turning their investments into liquid assets. This liquidity can be essential for diversification or personal financial goals. 3. Enhanced visibility and credibility. Being a publicly traded company often results in increased visibility and credibility. It can attract customers, partners, and talented employees who may prefer to work for or do business with established, publicly traded firms. 4. Acquisition currency. Publicly traded companies can use their shares as currency for mergers and acquisitions, making it easier to pursue growth through strategic deals. 5. Employee incentives. Stock options and grants can be attractive incentives for employees, helping companies attract and retain talent. How companies list via IPO. 1. Preparation. The company interested in going public works with investment banks, legal advisors, and auditors to prepare its financial statements, prospectus, and legal documentation. They must meet regulatory requirements and disclose financial information. 2. Selection of underwriters. The company selects investment banks as underwriters for the IPO. Underwriters help determine the offering price, market the IPO, and manage the sale of shares. 3. SEC filing. The company submits a registration statement to the U.S. Securities and Exchange Commission, SEC. If it's in the United States, similar regulatory bodies exist in other countries. This document provides detailed information about the company's financial health and operations. 4. Roadshow. The company conducts a roadshow to promote the IPO to potential investors. This involves presentations and meetings with institutional investors, analysts, and others interested in buying shares. 5. Pricing. Based on investor demand and market conditions, the underwriters set the IPO price. This is often a balance between maximizing funds raised and ensuring a strong aftermarket performance. 6. Trading debut. On the IPO day, the company's shares start trading on the stock exchange. This marks the company's transition from being privately held to publicly traded. 7. Post-IPO compliance. After going public, the company must adhere to ongoing regulatory requirements, including financial reporting, disclosures, and corporate governance standards. 8. Market performance. The company's stock price is determined by supply and demand in the open market. It can fluctuate based on various factors, including financial results, industry trends, and economic conditions. In summary, an IPO is the process by which a privately held company becomes publicly traded by selling shares to the public through a stock exchange. It provides access to capital, liquidity, credibility, and growth opportunities, but also involves significant regulatory compliance and public scrutiny. Chapter 4 uploading soon. To invest and trade in stock market, open a free Demat account, link given in description. Like, share, subscribe to watch more videos about stock market and trading.